specifically to the US, you had the situation in the job market. With a sharp rise in unemployment first in spring 2021, and nearly 2 years after, you have still more than 2 million jobs missing on the US job market, with very unusual developments now with, for example, wages of low-paid jobs posting the highest increases. We can clearly see that the power has shifted from companies towards employees. The job market is very, very tight in the US. The unemployment rate has fallen below 4% of people quitting voluntarily their job, as you can see on the graph, have never been so numerous, and the wages continue to accelerate. That is on the upper hand graph on the right. You can see the comparison between the evolution of wages in 2021 and the same evolution during the pre-crisis period between 2015 and 2019. There is an obvious acceleration.
More or less say that demand is back to pre-COVID level, except for jet demand. So aviation is the big missing piece. But as you can see, the Omicron wave had a very little effect on global jet demand. That's the second chart you can see on the gray area. So when Omicron reaches level daily cases comparable to other waves, there's just very little effect on jet demand. And the pent-up demand that is available for incremental growth is still quite big. You can see there's a 2.5 million barrels per day upside on the global jet demand.
The supply deficit is still strong, but if you look at the trend in net storage withdrawals at the end of the year, we even managed to have some net injections, meaning that we switched from net withdrawal to net injections, which is quite unusual during the winter, just to, as a way to show that the balance was a little bit less tight, thanks to LNG and also thanks to LNG and Norwegian supply. But the storage deficit is still there. Just look at the graph on the right, and we believe that we should maintain this trend until end of March.
Now looking at the forward prices, so not much surprise, but a few interesting things to notice. First, of course, the forward prices spiked as well, especially at the end of the year, tracking the skyrocketing gas prices, and of course on raising concerns regarding the nuclear availability coming for the upcoming year. But what is, I think you should notice, is that only the Cal 22 really surged. When you look at the other dotted line, which represents the Cal at the time Cal 23 and Cal 24, you can see that they were quite spared by the crisis and the really, soaring energy prices. And that's very interesting because it reveals two things. The first one is that the market considers the current energy crisis as temporary and not as a structural change of the market. And the second one, and this is more for the outlook, it means that actually the bearish potential of those deliveries, so basically Cal 23 and 24, are actually limited because since they're rise not as high as the Cal 22 at the time, well, says they cannot correct as much in the upcoming months.